Low interest rate environments, often used by central banks to stimulate economic growth, have been a defining characteristic of global monetary policy since the 2008 financial crisis and again during the COVID-19 pandemic. While these measures have succeeded in preventing economic collapse, they have also had unintended consequences, most notably, the exacerbation of the wealth gap between the rich and the poor. This report explores how prolonged periods of low interest rates have disproportionately benefited the wealthy, leaving the working and middle classes behind. The mechanics of low interest rates are a key tool of monetary policy. When central banks, such as the U.S. Federal Reserve or the Bank of Canada, lower interest rates, borrowing becomes cheaper. The intent is to encourage spending, investment, and lending, thereby boosting economic activity. However, low rates also reduce the returns on traditional savings and fixed-income investments, pushing capital into riskier assets like stocks, real estate, and private equity, assets that are overwhelmingly owned by the wealthy. Asset inflation and wealth accumulation. One of the most significant effects of low interest rates is asset inflation. As capital searches for higher returns, demand for assets such as real estate, equities, and collectibles increases, driving up their prices. The wealthiest individuals, who already own a disproportionate share of these assets, see their net worths skyrocket. For example, between 2009 and 2021, the S&P 500 index grew by over 400%, greatly enriching those with significant equity holdings. At the same time, housing prices in many global cities doubled or even tripled, making homeownership increasingly inaccessible to lower-income families. This asset-based wealth creation has created a feedback loop. The more the wealthy own, the wealthier they become. The decline of savings and fixed incomes. On the flip side, low interest rates have hurt savers, particularly retirees and middle-class households that rely on fixed-income investments like bonds or savings accounts. Traditional saving mechanisms, such as certificates of deposit or government bonds, now yield historically low returns, often below inflation. As a result, these individuals see the real value of their savings erode over time. In contrast, the wealthy are able to hire financial advisors and invest in higher-yielding assets, including hedge funds, real estate investment trusts, REITs, and venture capital. Access to these tools is often gated behind wealth thresholds or sophisticated investor requirements, further widening the gap. Cheap credit and wealth concentration. Low interest rates also provide cheap credit, which has allowed corporations and wealthy individuals to borrow money at unprecedented levels. These loans are often used not to create jobs or invest in long-term growth, but to buy back shares, boosting stock prices, acquire competitors, or purchase luxury assets. For instance, from 2010 to 2020, U.S. corporations spent trillions on share buybacks, benefiting shareholders and executives, but offering little benefit to the average worker. Similarly, wealthy individuals use low-interest loans as leverage to invest in appreciating assets, while the poor often cannot access affordable credit or are stuck with high-interest loans from predatory lenders. Real estate. A case study. Real estate exemplifies how low interest rates benefit the wealthy while harming the poor. As mortgage rates fell to historic lows, wealthy investors took advantage of cheap financing to buy multiple properties, either as investments or rentals. This has led to a surge in property values and a corresponding increase in rent prices. For low-income families, the dream of homeownership has slipped further away, and a larger portion of their income is now spent on rent. Moreover, neighborhoods in many cities have experienced gentrification, displacing long-time residents and consolidating property ownership in the hands of a few. Impact on wage growth and labor markets. While asset owners have benefited immensely, wage growth has remained stagnant for many working-class individuals. The labor market has become increasingly polarized, with high-paying jobs in tech and finance expanding, while many service sector jobs remain low-paid and insecure. Low interest rates have also contributed to the rise of the gig economy, where companies rely on flexible, low-cost labor instead of full-time employees. These workers lack benefits, job security, and often earn less than traditional employees. This labor model disproportionately affects younger and less educated workers, further compounding inequality. Monetary policy and policy blind spots. Central banks have focused largely on inflation targeting and economic stabilization, often overlooking the distributional effects of their policies. While low interest rates can prevent recessions and encourage recovery, They are a blunt tool that benefits capital more than labor. Without complementary fiscal policies, such as wealth taxes, universal basic income, or affordable housing programs, the benefits of economic recovery are unevenly distributed. Moreover, central banks operate independently and are not directly accountable to voters. Their mandates rarely include addressing inequality, even though their actions significantly influence wealth distribution. COVID-19 pandemic. A catalyst, the COVID-19 pandemic accelerated these trends. In response to economic shutdowns, central banks slashed interest rates even further and introduced quantitative easing, QE, purchasing government and corporate bonds to inject liquidity into the financial system. While stock markets rebounded rapidly, millions of workers faced layoffs, reduced hours, or wage cuts. The K-shaped recovery became a common term. The rich recovered and grew richer, while the poor fell further behind. Billionaires saw record gains during this period, while food bank usage, homelessness, and personal debt surged for others. Statistical evidence. According to the Federal Reserve, the top 10% of U.S. households own nearly 89% of all stocks, while the bottom 50% own just 1%. A 2021 OECD report found that during the post-2008 recovery, the wealth of the top 1% grew 4 to 6 times faster than that of the bottom 40%. In Canada, the average home price rose by over 70% between 2015 and 2022, outpacing wage growth and increasing the barrier to homeownership. Conclusion and recommendations. The prolonged low interest rate environment has undeniably contributed to a growing wealth divide between the rich and poor. While the intent behind low rates is to stabilize economies, the side effects, acid inflation, cheap credit for the rich, declining returns for savers, and stagnant wage growth, have structurally disadvantaged the working and middle classes. To counteract this, policymakers must 1. Introduce progressive taxation on wealth, capital gains, and inheritances. 2. Support affordable housing initiatives and limit speculative real estate investment. 3. Expand access to financial instruments for the middle and lower classes. 4. Reform central bank mandates to consider inequality as a key factor. 5. Promote wage growth through labor protections, union support, and living wages. Without coordinated monetary and fiscal reforms, the divide between rich and poor will continue to grow, undermining social cohesion and economic sustainability in the long term.